Happy Friday, everyone. It's a great Friday. I had a cheeseburger yesterday, so life is good. Yeah, it's the little victories that are important. It's a good Friday for you all because you no longer have to hear me remind you about the Excel assignment. The Excel assignment is submitted. Right. So Clay will be on top of that. We'll get those back to you. Yeah, I still have not gotten any requests for presentation dates for the groups. I hate to keep harping on that, but please let me know if you have a specific day that you would like to present on. More importantly, let me know if you have a presentation day that you cannot present on, because that's the real most important one. But we have a little flexibility for that. As I said other times in this course, I know that I'm the gatekeeper between you and the weekend, especially on Fridays. So I take that responsibility very seriously. Good news is I don't think today will be particularly onerous. We'll get through some stuff, but we got to talk about homework and get through the tasks today. So what do you say we crack out some payroll and inventory discussion and we'll call it an early day after that? Yeah. All right. There's the most enthusiasm I've seen. Yeah, it's like early day. Yeah, I'm on that. More Dr. Barnes. Yeah. So let's start out with chapter 12. Which of the following procedures would most likely be considered a weakness in an entity's internal control over payroll? Well, if it's Dr. Barnes' question about internal controls, it's probably going to have something to do with segregation of duties, right? Yeah, so let's just go ahead and look through the answers and see if we see anything that comes up. A voucher for the amount of the payroll is prepared in the General Accounting Department based on the payroll department's payroll summary. So we're creating a package, aggregating all the documents together to make sure that they match everything. That just sounds like good common business practice. Make sure we aggregate documents where we have reference. So I'm willing to say A is fine. Payroll checks are prepared by the payroll department and signed by the treasurer. That sounds like good separation of responsibilities. That sounds like we've got one that does the recording function and one does the authorization function, and those don't overlap. What about employee distributes the payroll checks, returns the unclaimed payroll checks to the payroll department? Well, we just said the payroll department's responsible for recording. If you've got those payroll checks in hand, you probably have custody, and those, and we know checks that are signed are bearer instruments. So have we heard that term before, bearer instruments? Have you heard that term before? I know we have, but have you heard that also? So a bearer instrument basically means that it's negotiable, that it's been endorsed, and so you can actually trade it as cash. So having payroll checks in possession is a custody function. We do not want to give bearer instruments to entities and organization that have a recording function, because imagine what would happen in this situation if the payroll checks are returned to the payroll department. Someone in the payroll department says, I could exchange this for cash. I'm just going to eliminate this from the record. It never got recorded, and all of a sudden, free cash. Now, I'm a fan of free cash, but not at the expense of fraud. Not at the expense of fraud. So C is going to be our answer, but let's go to D. Human Resource Department sends employees termination notices to the payroll department. Again, that just sounds like a very good control. We probably don't want to be paying employees that are no longer working for the organization. All right, so C is our answer. All right, now I really like this next question here, because this is the type of question you could expect to see me asking on the exam. The purpose of segregating the duties of hiring personnel and distributing payroll checks is to separate what? So in order to understand segregation of duties, we probably should make sure we understand what areas are being separated out. So hiring personnel, that's going to be the human resources function, which we said is what type of function? You got choice of 3, so 33% chance if you don't know. Authorization, yeah, authorization is going to be a good one, yeah, because we have to authorize personnel who can work for the organization. Distributing payroll checks, we just talked about that one. The payroll checks themselves, they're usually bearer instruments because they've been signed by the organization, so they can be cashed. They represent assets, so that's going to be custody. So we're looking for something that talks about the representation of separating authorization from custody. Now, are there any of these answers that represent that's concept? Let's look at C, authorization of transactions from the custody-related assets. Wow, that sounds like spot on what we were just talking about. C is our answer there. That's how we actually approach those questions. Again, my wording would be a little bit different. I would probably use different terminology, but this is the kind of question you could expect to see on the exam, the type of thing to ask. Question 1221, I don't know how to feel about this one. On one hand, I'm really happy with the way it's worded now, but this is actually a recent change. This edition has changed. So we're going to talk about the answer. We're going to talk about why I have mixed feelings about this. I think it's a fine question now, but I used to get really frustrated at it. So which of the following audit tests would most likely be used to test the occurrence assertion for payroll transactions? Now we see occurrence, you should think what? Existence occurrence, existence occurrence. You're actually right. We also think that as well, but I want to make sure that we get the full assertion there. Now we're talking about existence occurrence. Now we're looking for vouching. Now again, we have to be very, very careful because when we think about vouching, we have to make sure it's proper direction. So let's go ahead and look at the answers and see what the concepts they represent, and we're also going to associate them with different assertions. So trace a sample of timesheets to the payroll register. So first of all, is trace used correctly in this answer? It is absolutely used correctly in this answer. So if it's a tracing test, it's testing which assertion? Completeness. Good, good. Recompute the mathematical accuracy of a sample of payroll checks. So recomputation is a specialized test and only tests one assertion. So which assertion is it? BAA, yeah. Vouching a sample of payroll checks from the payroll register to the approved timesheet summary and the master employee list to verify validity. So payroll checks, you can argue, are a source document, but they're a very high level source document. They represent what goes in the system. And we're going back to the original source document. So this sounds like a vouching test to me, which means that we're talking about vouching, we're talking about this occurrence. So this is our answer right here. And then testing a sample of timesheets in the presence of authorization. This is just going to be an adequate control. You could say it also tests the assertion of authorization, Dr. Parts. I'm going to slap your hand. Not a real assertion. Not a real assertion. But yeah. So C's answer. Now, why am I so have such bad feelings about this? Up until this edition, this word at the very beginning of answer C did not say vouch. Guess what it said? It said trace. And it was so incredibly confusing because, the direction is wrong for tracing. It's actually a vouching test. And I used to say how angry I got at the publishers for putting this in there. They actually corrected it. I would like to think in large part based on my feedback, because one of the areas that I did, but they ignored me on a lot of the other areas. We're going to see another one that I've actually sent multiple comments to the publisher saying, yeah, you need to clean this up. This is nonsense. But this is one they fixed, and I'm very, very proud of them. Okay, like a proud parent saying, my child's growing up. They're getting so smart. And anyway, 1223. An auditor is most likely to perform substantive tests of payroll transactions and test the details of payroll account balances when what? So, what do these types of tests sound like to you all? What do these types of tests sound like? Substantive test of payroll transactions kind of gives it away. So we're talking about substantive test of details, right? So we're talking about the very end of the audit testing process. Because remember, we've got risk assessment, then we've got test controls, and substantive analytical procedures that all occur before this. So this question is asking, logically speaking, something had to happen before we can actually, before we actually make a conclusion. We need to perform substantive test of details over payroll. So what is going to be the most likely answer? The answer is what happened previously that caused us to make sure that we wanted to perform these substantive tests. So let's think about this. Cutoff tests indicate a substantial amount of accrued payroll expense. So cutoff tests, when do these get performed? When do cutoff tests get performed? As substantive test of detail. So these could not have been performed and said, let's perform substantive test of detail, because these are already being performed as substantive test of detail. Level of control risk relative to payroll transactions is set at low. All right. So if control risk is low, that means risk of material misstatement is likely what? Low or lower. Okay, it's going to be low because remember, stages is going to be low concept. Control risk is low. Detection risk is high. Detection risk is high. That means their substantive test of details is going to be low. So it's possible that we could say that controls are going to heavily mitigate the need for substantive test of details. If the substantive analytical procedures are very effective, it can eliminate them altogether. So this is not a good answer for this because this is the opposite direction we want to go. Substantive analytical procedures indicate unusual fluctuation in recurring payroll entries. So you look at substantive analytical procedures, you see something that does not make sense, and you say, I need to investigate this further. So what occurs right after substantive analytical procedures? Substantive test of details. So that's basically where we say, look, we've found something that's suspicious, something we don't understand. Let's investigate it further. Let's do these tests up here to investigate this further. So C is our answer. Let's look at the accrued payroll expense consists primarily of unpaid commissions. That actually would reduce any concern we have, because if it's unpaid commissions, that's something that we would expect to see in accrued payroll expense. That's not something that would be suspicious. So C is clearly our best answer here. This is kind of an interesting, question because it goes back to some concepts we talked about earlier in the course and refers back to them. Remember, I said you had to remember those things moving forward in the course. This is a good example of that. All right, moving on to chapter 13, which I did not get chapter 13 already open, so it's gonna take me a second. Talk amongst yourselves. What's your favorite substantive test of details? I personally prefer cutoff test cognitive artists. I'm a confirmation person myself. Kind of conversation I expect to see. All right, 1315. Which of the following control activities would be most likely to assist in reducing control risk related to the occurrence of inventory transactions? Now, same issue, talking about existence occurrence. Which one would would reduce the control risk related to the occurrence of inventory transactions occurrence? All right. So basically what we're saying is, which of these represents a good control that might reduce control risk? Now you can keep in mind that we're probably related to existence occurrence, but this is something that you have to keep in mind, but it's not necessarily relevant to the answer we're looking at here. The more important part of the question is, which of these represents a strong control that, if effective, would reduce control risk? So inventory management does not have managers not have the ability to record inventory transactions. This is an interesting one. So if you're the inventory manager, you probably have supervision responsibilities. What is another word for supervision? Begins with an A. Authorization, yeah, authorization, okay. So separating out authorization and recording functions, that sounds like a good control to me. So I'm likely to answer A, but let's go through the rest. Summary of the received reports is independently compared to the inventory status report. Okay, so this is probably an interesting control with respect to relating to inventory transactions. The question is, does it relate to the existence occurrence of inventory transactions, or is it more concerned with another assertion area? I would say it's probably more about valuation, or probably more correct accuracy with respect to VAA. Inventory is periodically reviewed for slow-moving or obsolete items that may require a write-down. Same concept, a good test or good control that be in place here. But does this relate to existence occurrence? No, the inventory we can already see is present there. The problem is the inventory is not at its properly realizable value, which is probably a valuation concern. So we're probably talking VAA again. Subsidiary ledgers are periodically reconciled to inventory control accounts. This is an interesting one. I think this is an important test, but this is more about the recording of these items, not about whether or not these items actually exist. So we have to make sure that these get recorded within the system themselves. So I would say this is more about making sure that these are properly recorded, which would be more of a completeness concern. So an interesting question there. I think at the face value, the one that makes the most sense is going to be A, just making sure that we don't have fictitious transactions being recorded. All right. Let's go ahead and move on to 3317. Independent internal verification of inventory, and I like how they provided proper segregation of duties, because we know what that's relates to. Occurs with employees who do what? So what do we want? We want separation of responsibilities, obviously, custody authorization reporting. But keep in mind here that just because you see a separation of responsibilities does not mean it's the correct answer. We have to make sure that those specific responsibility areas are being separated out. So issue raw material, obtain requisition issue, reissue, and prepare the daily totals of materials issued. Now, are any of the three responsibility areas being separated out here? No, it sounds like a recording function all the way through. Okay, and if it's not a recording function, it's basically making sure that the information that you're recording is accurate. So I don't think there's a separation of responsibilities going on here in A. Compare records of good on hand with physical quantities. Do not maintain records or have custody of the inventory. So compare records of good on hand with physical quantities. Okay, so we're basically checking information. We're authorizing to make sure it's correct. Not maintain the record sounds like recording, or have custody of the inventory. Custody, authorization, recording, and custody being separated out. So sounds good. By the way, I do want to take a little bit of umbrage here. Okay, so I've heard tell stories that one of the accounting professors is teaching segregation of duties as ARC, okay? That is completely wrong. It is CAR, custody authorization recording. If you put ARC on the exam, I won't count it wrong, but I'll be really angry at you, all right? I'll be really, really angry at you. So we need to talk to that instructor and say, got to get it right. It's CAR, custody authorization recording. Very insistent about that. Very, very passionate about this. All right. Obtain receipts for the transfer completed work efficient goods, prepare a completed production report. So basically, we get the receipts and we prepare the proper records that are necessary. It's just a straight up recording function, arbitrary duty. Arbitrary duty. That's hard to say. Okay. Are independent of issuing production or orders, update records, completed job sheets, and prepare production cost reports on a timely basis. Again, all of these represent recording functions. I don't think we need to separate out those responsibility areas. So B is kind of the clear answer, just because those are separate responsibility areas that we want to note. At the very least, the fact that we see custody of the inventory being separated out from recording functions is a pretty clear indicator there. All right, 1320. An entity maintains perpetual inventory records in both quantities and dollars. If the level of control risk was set at high, auditor probably would do what? So let's think about this. So control risk being set at high, what is that telling you about the controls? That we believe controls are effective, not effective, or something along those lines? We assume that they're less effective, or at the very least, we're not going to test the controls to make an assumption about their effectiveness. So either the controls are being ignored, which would be like a substantive strategy, or we've tested the controls and the controls are not effective. We have conclusive first. Regardless, control risk is set high. Now, assuming that inherent risk is going to be at high, which it almost always is, what does that mean about risk and material misstatement? It's going to be high as well, okay? Risk and material misstatement is high, detection risk is, oh, that's good. We like low detection risk, right? We hate low detection risk, okay? That means more work for us as auditors. So what is the purpose of gaining or doing more work? It's substantive procedures. Remember those things, the assurance buckets back in chapter 5? Or if you don't like the assurance buckets like me, the assurance Chipotle burrito? What was the whole goal of that process? Why did we have to do more work at the end? To gain more what? Assurance. Yeah, I kind of gave it away when I said assurance buckets. But yeah, gain more assurance. Yeah, gain more assurance. So we're looking for something that will give us more assurance. That's kind of the answer that we're looking for here. So let's go through. Insist the entity form physical accounts of inventory several times during the year. Does that have any relevance whatsoever? I'm guessing somebody in this room answered that question. If you did, don't feel bad. You are not alone. There's a lot of people who've answered that answer. But what is the purpose of an inventory account? To ensure that the year-end balance is accurate. So if I decide, well, I'm going to be super thorough, I'm going to count it multiple times during the year. That way, the year-end balance will be super accurate. What point in time do I care about the balance of inventory? Year-end. So every single one I've done before that, if I count it on a daily basis, does that have any relevance whatsoever? The only one that's relevant is that very last one. All right. So that's a kind of a trap question. And again, it's a really, really tricky one to answer because it looks like, well, they're being thorough. That's more assurance. No. Okay. It's not more assurance. It's the only thing we care about is the year-end balance, or the year-end count. Apply gross profit test to ascertain the reasonableness of the physical accounts. Now, if we perform a physical count, is that going to give us more assurance than a gross profit test? I would assume so. If I say, okay, if I count the number of desks in this room, and I can say, okay, well, there's 30 desks. I don't know how many desks there are, but let's say I do a count, there's 30 desks. And then instead I say, okay, I'm going to count the space in the room, the volume of the desk occupy, and then I'm going to divide that by a certain number, and I'm going to approximate that it's 28 desks. So you're off by 2. That's going to be one that that's the wrong direction. I would assume that if I make an estimate first, that's going to be less effective than doing a full physical count. So I don't think B makes a lot of sense. Increase the extent of test controls over inventory management process. So we've concluded control risk is high. Does that mean that we've already tested controls? Yes. So increasing the extent of test controls is not relevant. It doesn't really have any bearing in this because we've already tested controls and just basically said controls are not effective. There's no point in testing them any further. That leaves D, and hopefully D gives us some guidance here. Request the entity schedule the physical inventory count at the end of the year. So which is going to be more effective, doing an inventory count during the middle of the year or during the end of the year? End of the year, it's going to provide us a lot more definitive proof about what the balance is at the year end. So that's going to be a lot more assurance than doing it at some interim point. So that's the one that I look at and I think I'm getting more assurance here. That makes the most sense that we would all make that change because that provides more assurance. So that was a really challenging question. You had to think a lot about that, but again, big thing to think about these things. When auditing merchandise inventory a year, an auditor performs a purchase cutoff test to obtain evidence that what? So let's just go ahead and go through the answers again. All goods purchased before a year end are received before the physical inventory count. So is it possible that you can make a purchase for goods and not receive them for several days after that? Yeah, is it possible that you could not receive goods before you're scheduled to count inventory? There's a delay in shipment. Well, we just have to cancel inventory observation then. No, we can account for that. That's a possibility. So A is not a requirement. No goods held in consignment for customers are included in the inventory balance. I mean, actually, goods held in consignment for customers should be included in the inventory balance if we have ownership of them. So that's not a correct answer. Goods observed during the physical inventory, physical count are pledged or sold. Okay. So if they're pledged or sold, that's kind of a tricky situation, especially if they've already been sold and the customer is taking responsibility for them. That's part of the contract. Then they may not actually be something that's been part of the account. Alternatively, if they are pledged or sold, they may not be visible to us. They may be in a different location in the warehouse. So it goes both directions. So all goods owned at year end are part of the inventory balance. That is kind of the one that I was looking for here. If we're talking about goods that are owned at year end, that means that we have the rights and obligations to recognize that in inventory. That's what should be included in the account, and that's what should be included in the inventory balance. So D is kind of the clear one right there. All right. Inquiries of warehouse personnel considering possibly obsolete or slow-moving inventory items provide assurance about management's assertion of what. So what are we talking about? We're talking about inventory obsolescence. Remember those BlackBerries that I was talking about? I was so fond of the BlackBerry device, and I said, hey, let's say I have a client that's got boxes and boxes full of BlackBerries. And I said, market's going to turn around someday. We're going to sell these, and we're going to make tons and tons of money because people are just waiting for that. And they've been saying that for the past 10 years. What are you as the auditor going to insist? It says, look, I know you paid like $100 a piece for them, but you're not going to recognize anything. You're going to have to write this off to their market value, which is basically zero, because you're never going to sell those again. So if we're writing something down to a market value, which again, you only get to do that in certain circumstances, the fair market value is substantially less than the historical cost. If we're writing that down, what would that most likely reflect? Which assertion? VAA, valuation, allocation, accuracy, or valuation context. Yes. All right, let's move on to the cases. Or to the problem first in the case. All right, so we have another question here where we've got some audit procedures. We need to pair these to the specific assertions. Now, I want to take a look at a couple things. So, first of all, 4 of these 5 are very, very straightforward. We've got rights and obligations, completeness, VAA, or valuation, VAA, and then valuation again, but one's more valuation, one was accuracy based. And then we got completeness and accuracy and valuation for presentation and disclosure. This is the one I was talking about. This is the one that I complained about. It says, can we just make this presentation? Can we just make this presentation? It's confusing, it's the way it's worded. And apparently they're just like, well, we're too busy. And that would have required deleting some stuff that we don't want to delete. So let's just think about this as presentation. Now, keeping in mind that those are the assertions we're concerned about, let's go back up here, okay? So we've got 6 items here. Now, I think one of the easy ways to look at this is look and see if we've got any that represent assertions that we haven't talked about. So I want to look at 5. Select a sample of recorded items on count sheets during the physical inventory count and determine that those items are in hand. So that sounds like a sheet to floor test. What is sheet to floor supposed to test? Which assertion? Existence occurrence, okay? Existence occurrence is not given down here as one of the specific assertions, so we can actually get rid of number 5. We're not going to use it. By the way, this is actually a shortcut for something we'll be doing a little bit later. If you see multiple options and you only have a limited number of selections, start with determining what the assertions are relevant to a particular test, and then you can apply them from there. That's going to be an easy way to approach this. This will actually be helpful for the next homework assignment. So we've got a problem just like this in the next homework that's completely and totally nightmarish. Okay, it's ridiculous. There's only 3 assertion tests down here, but there's like multiple items, and they all represent various assertions. All right, so ensure the entity has legal title to the inventory. All right, so we've talked about legal title already. We actually talked about this last week, last Wednesday. We did the homework. So talked about this last week. What's an easy way to determine legal title? We're probably talking about high-level documents that actually pertain to legal title of items. So loan agreements and board of directors meetings. Yeah, so that's going to be something we would all look at. That was kind of the same concept we talked about with respect to the purchase agreements. We did the same testing there. So A is 6. All right. Ensure that recorded inventory quantities include all products on hand, which is completeness. So if we're talking about completeness, we're probably talking about making sure that we're going in the correct test. So 5 was saying we were moving from sheets to floor. We're moving from what's in the system to what's on the warehouse floor. So does it make sense that if we went from floor to sheet, we'd be doing testing completeness? Yes, because it's opposite direction. Remember, completeness and existence, occurrence are opposite. So select a sample of items during the physical inventory count, determine they've been included on the count sheet. So we're moving from floor to sheet. So 3 is our answer there. Verify the inventory has been reduced when appropriate to replacement cost or net realizable value. So this is actually really important. In order to determine net realizable value, we have to have a source of what the current net realizable value is. What would be a source, if we're talking about inventory, what would be an easy source of what you could actually exchange this for on the open market? What the vendor charges you for it? So like say for example, you wanted to get rid of inventory that you have excess of. Could you charge roughly the same price as what your vendor charged you? Probably so. So if we look at the vendor price lists, that would be an easy way to do this. Now, D says to verify the cost of inventory has been properly determined. Now, I'm going to tell you right now, the way that the book says that you answer this is select a sample of records and examine support vending invoices and contracts. That's what was paid for it. That was actually paid for it. And I think that's an appropriate test. If you answered 1 for that one, I also think that'd be correct. This is not what the book says, but I think you could actually verify this information also by going to the vendor price list as well. So 1 and 4 both make sense, which again makes sense because we said that they're the same assertion effectively, BAA. So now the question is, could you actually could you use 4 to determine C? The answer is I don't think that's the case. I don't think you do the test on 4 to actually determine the net realized value. Because if you bought it at some point in time in the past and the value is substantially changed, then you want to know what the current value is. So that's why that doesn't work. All right, verify the major categories of inventory and their basis for valuation are adequately reported in the financial statements. In other words, this information that has to be disclosed actually has been disclosed in the financial statements. All right, that's all this is really saying. There's using a lot of big words that again an editor got confused about because let's be honest, auditing is confusing. So if we're talking about stuff that goes in the financial statements, probably want to look at the financial statements. Can we say that? So 2, reviewing the drafts of the financial statements. Test. All right, my favorite part of the entire day, we get to talk about Ando Company. Ando Company. So anybody reading through this case and just kind of like going, oh my gosh, oh my gosh, oh my gosh. If you weren't excited enough. All right, so I'm going to read through it again. We're going to do some oh my goshes. All right. So Ando Company, a diversified manufacturer, has 6 divisions that operate through the United States and Puerto Rico. Ando historically allowed its divisions to operate autonomously. So the people who are in charge, they basically get to make the decisions there. And we're going to talk about JP Kumar in a second, who's taken a lot of liberties with that particular policy. Ando does not have an internal audit department, and corporate intervention only occurs when planned results were not obtained. Well, that's a great policy right there. As long as corporate results are obtained, then we don't have to step in because everything's going fine. The financial statements are good. Everything's good, right? No fraud could possibly taking place. All right. Ando has a policy of hiring competent people. Management is fairly conservative in terms of accounting principles and practices, but employee compensation depends in large part on performance. Going back to chapter 4, we talked about something that this is represented. Remember that triangle thing that we talked about back in chapter 4? What does that sound like to you when we talk about compensation depends in large part on performance? Give me hints. One of our 3 fraud risk factors. Pressure, incentive or pressure, yeah. So now we talk about how Ando has a policy of hiring competent people. I think JP Kumar is a very competent individual. More appropriately, he's a competent individual at committing fraud. All right, so good project. So for those of you who are going to the MAC program, there's one thing that I like to say when I teach the forensics courses that I will teach you very, very heavily about how to commit fraud. You will be an expert in committing fraud. And you will be like going out and you'll be able to become a white collar criminal if you want to after you go to Jim State. I hope you don't. I hope the ethical thresholds that Dr. Terra has instilled upon you as let's be honest, it's not going to be my class that's going to install ethics on you. Yeah. But Dr. Otero's class, yeah, Dr. Otero's, maybe some of the other instructors. Yeah. So it actually takes a little bit of knowledge in that area. And I'm going to say, this is one of those ones that JP Kumar, I'm like, bravo, good job. So General Manager of the Appliance Division that produces a variety of appliances. J. Kumar has been able to improve profitability of the division through each of the 5 prior years. All right, well that's pretty good. Improve profitability. That's a good signal right there. Okay. Much of the improvement came through cost cutting, including a substantial reduction in control activities over inventory. All right, take my claps back. All right, how do I unclap? How do I unclap? That's all I want to know. Recently, new competitor has entered the market and offered substantial price discounts in an effort to grab market share. All right, remember that triangle thing we just talked about? Does that represent a new pressure? Yeah, we have 2 pressures here, okay? Kumar is concerned because if the profitability is not maintained, his bonus will be reduced. Dun, dun, dun. All right. That's the MacGuffin of this particular story. Kumar decided the easiest way to make the appliance division appear more profitable is through manipulating inventory, which was the largest asset on the books. Kumar found by increasing inventory by 4%, income being increased by 8%. All right, we talked about this already, but does everybody understand how this works, how this operates? So this is the one that I talk about, and I say everybody should understand this because increasing inventory is going to increase revenue. And it doesn't make intuitive sense unless you understand the equation represented. So I'm going to flash back to 221. So remember back to 221. You had this thing called this formula or beginning finished goods inventory plus cost of goods manufactured, cost of goods sold minus cost of goods sold equals ending finished inventory. I actually call this the base equation. That's what I talked about it when I was at 221 because it's a very simple thing, concept to represent. Beginning plus additions minus subtractions equals ending. Now, you may say that's not quite right, Dr. Barnes, and you're absolutely correct. You did have to reorder it a little bit. You had to change it to beginning plus additions minus ending equals subtraction because of math. All right. This is the way math works. We can actually transpose these two right here, and it still works out. So calculating cost of goods sold is going to be a function of beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. And cost of goods sold, we know, flows into income, whether that be net income, EBIT, or EBITDA, et cetera, whatever it is. So the higher cost of goods sold is, the lower income is, and vice versa. Now, how is this represented? So we have an example here, and I just made up these numbers out of whole cloth, but I did want to illustrate what's going on here. And again, I do this because I want to make sure this is a concept that I've talked about already in this course, and it's something that's really important for fraud detection prospects because this is a very common fraud scheme. So let's say beginning finished goods inventory was 100,000, they manufactured 500,000, or purchased. You could actually say these are purchased. Well, if they're talking about a retail environment, then ending inventory is 80 million. Or I said 80,000, but I meant 80 million. So we have cost of goods sold of 520 million with income of 120 million. So if I change this to 90 million, should have just typed a 9 at the beginning, trying to count all the zeros, it's rough. Cost of goods sold goes down and income goes up. That's all there really is to it, but it's really, really critical to understand that concept. Again, I'm assuming that you probably already had that intuitive knowledge, but this is a really important thing to understand because it doesn't make sense when you say, if I increase inventory, I increase income. That statement by itself does not hold water. So understanding we're increasing ending finished goods inventory, and because of the way that we calculate perpetual or periodic inventory, it reduces cost of goods sold, which in turn increases income. So everybody good on that? If I asked you this question on the exam, could you articulate this? I'm not going to ask you this question. So I'm just wanting to make sure everything I talk about is really important. So increasing inventory by 4%, income being increased by 8%, which because of inventory control, he felt it'd be easy to overstate inventory. So that is working smarter, not harder. Scrap internal controls, that's going to make it easier to commit fraud. So it's like double purpose. Not only do you reduce costs, but you also make your frauds easier to accomplish. All right, so using implemented, okay, so now we're going to be talking about some things that we need to know with the audit. So employees using the goods, employees count the goods using cost sheets, count sheets. And Kumar was able to add 2 fictitious sheets during the physical inventory, even though the auditors were present and observing the inventory. All right, so we've talked about inventory, controlling the sheets and controlling those documents. They have the sheets that are associated with the inventory count, and during the middle of the count, JP Kumar just basically stuck in more sheets. It's a problem, all right? That's a problem. We'll get to that, all right? Significant amount of the inventory was stored in the racks that filled the warehouse because of their heightened difficulty test counting them. Kumar was able to cover an overstatement of inventory in the upper racks. All right, guys. Talked about inventory counts. What was I doing at the beginning of January in Oklahoma? What did I tell you all I was doing? Climbing on top of 200-foot chemical storage containers, all right? In the middle of winter in Oklahoma, which is not as cold as Missouri, but still very windy and very cold, all right? If I have to do that, I don't want to hear you saying, it's really, really high to climb on top of the racks, Dr. Barnes. It's just so much work. Get up that ladder, all right? Get up that ladder. After the count was completed, Kumar added 4 additional count sheets that added 950,000, so snuck in more count sheets of an inventory that did not exist, or 8.6% to the stated inventory. Kumar notified the auditors of the omission of the count sheets and convinced them they were overlooked legitimate inventory. All right, so we've got 6 sheets that got thrown in for additional inventory. Now, here's the deal. The auditor could notify this, and they say, all right, I guess things happen, but we have to make sure this inventory was legitimate. What assertion are they concerned about with making sure this inventory is legitimate? Existence growth. They have to make sure this inventory actually exists. Are we on board with this? Okay. The auditors traced the items on the additional count sheets. Anybody upset now? So what is the word there that I'm really angry about? Traced. What assertion does that test? Completeness. They didn't test the right assertions to verify the existence. It doesn't matter if they say they traced to verify the existence and prove the addition of the $950,000 of inventory. All right. So basically what they did is they looked and they said, okay, can we actually see that this got put into the system, the items in the account sheets? Well, of course they got put in this system. It's actually where it came from. It's supposed to where it derived from. This is not supposed to be a tracing test. We're supposed to go to the warehouse and make sure we can find this stuff in the warehouse. Didn't verify. All right. They did notify management about the added sheets. In addition, Kumar altered other count sheets before sending them to auditors by changing unit designations, such as 6 motor mounts became 6 motors, raising counts and adding fictitious line items to completed count sheets. These other fictitious charges added an additional $375,000 in the inflated inventory. None of them was detected by the auditors. Now, obviously, this is a work of fiction, so something like this has never occurred in all of human history, right? It happens all the time. It happens all the time. The auditors say, I'm overworked. I'm just going to trust J.D. Kumar. He's a competent individual. A competent individual. Yes, very competent. All right, let's go to the answers. What audit procedures did the auditors apparently not follow that should have detected Kumar's fraudulent increase in inventory? So, with respect to the original count, what was the most important thing we talked about when we talked about the instructions? Maintain control of the count sheets. We shouldn't have JP Kumar sneaking in and putting more account sheets in there. We have to make sure the auditor has full control of that for this very reason. This sure sounds like we have a client that gets confirmation information for us. Why did we say it was so important the auditor gets confirmation information directly? Because we don't want the client manipulating the information. The same holds true for the inventory count sheets. Manipulation could occur. But ignoring that, okay, assuming that that was just an easy one, what else did they do wrong? So they found out about these new count sheets that were apparently just accidentally omitted. What was the responsibility then? Say, well, we got to make sure this stuff gets counted. Now, even if this was after the actual inventory and they sold some of the merchandise, could there still be some effective mechanisms applied here? Say, these are not going to exactly match, but we can get a good idea of whether these are reasonable estimates. They go into the warehouse and they say, all right, this says they had 500 motor mounts. I see 2. There's a problem here. Okay, there's a problem here. Or 500 motors, I guess it was, because those are more expensive than themselves. Shows how much I know about mechanics. I know mechanical items. Anyway, anything else that we talked about? So they did not notify management of the count sheets. I think maybe I said did. They did not notify management of the count sheets. So we already know management has a hands-off approach, but might there still be a reason why we want to notify management about this problem? So there's an acronym. So it's called Cover Your CYA. Okay, does everybody know what CYA stands for? All right. So in this particular situation, we want to make sure that the auditor has no liability, that they notified management that there was a problem, they're taking appropriate steps, but management should know about it. If management says, well, not our problem, JP Kumar can act autonomously, then our hands are clear. It's like, yeah, okay. Like the casino when you're saying, I'm walking away from the table, all right? I got no chips in my sleeves. Yeah, that's going to be basically what the auditor should have done. They didn't do that, and so they've got liability for the action. And then not checking to make sure that some of this is very, very spurious, like just making silly modifications that could add $375,000 to inventory, just after the fact modifications that take place. And again, that sounds so ridiculous, and it's a lot more difficult nowadays because of electronic record keeping, but it's still something that could occur with some frequency, especially in less legitimized environments where controls have been completely scrapped. So what would the implications be for the failure to detect material fraud described here? Well, at least JP gets his bonus. I guess that's good, right? Yeah, Kumar's going to get his bonus. But what would be the auditor's responsibility, especially if they found out that there was fraud being taking place? Is the auditor going to be held liable in this particular situation? The answer is yes, but you may be even worse than you're thinking. Okay. Now you're saying, Dr. Barnes, would I as an associate be held personally accountable? The answer is no. Okay. Usually it's going to be associated with the partners. Your firm will be held accountable, and if it's enough of a problem, then your firm may actually go belly up. Okay. Now, if you go to work for a big 4 firm, that's not likely. If you go to work for a large regional firm, that's not likely. If you go to work for a small firm, that's a possibility. Now, the problem is not only are the auditors going to be held liable, they could be held liable for greater than their share. Now, joint and several liability is not common anymore with respect to auditing, but if the auditor exhibited gross negligence, like in this particular situation where they should have known something was up and they didn't, this could something that they could actually be held accountable for more than their share of what would be responsibility. It's usually the separation of accountability goes partially with the organization, but partially with the auditor. Auditor is going to have some sort of accountability. We were operating back in the 1990s, which I know that was a long time ago, but operating back in the 1990s, auditors would have been held fully jointly severally liable, which means that the company is bankrupt. The accounting firm would have to pay all of the damage. Well, that's a scary thought, isn't it? Is everybody happy now that we don't live in the dark ages? It wasn't that bad. We didn't have cell phones, but it wasn't that bad. Okay. Anyway, according to the auditing standards listed at the start of the chapter, what responsibility do the auditors have to discuss their concerns with the entity's audit committee? So this kind of goes back to some of the standards we've talked about with respect to due professional care and the reporting standards we've discussed. Let's just talk about this at a very general level. It's not really important that you understand the auditing standards specifically per se, but let's go ahead and discuss this just really quickly. So what responsibility do auditors have to discuss their concerns with the entity's audit committee? Do we have any reporting responsibilities with respect to the audit committee? So this has to do a lot with controls, and we know the controls were really problematic. So the first thing we could have noted is say, look, there are definitely control deficiencies that are happening here at this particular location simply because this guy has scrapped controls to the point that they don't exist anymore. Secondly, if we're talking about misreporting and misrepresenting information, there were very obvious disparities. Even if we don't know what the exact extent of JP Kumar's damage is, there's so much suspicious behavior that we probably should have figured out something wrong. Okay. So this would be something that we'd want to really check to the audit committee and say, look, you need to take a heavier hand on the management of these organizations because basically the individuals who are responsible have full autonomy and they can do things that can completely totally skew the actual results. And because of your necessity to actually achieve certain operating results, there's going to be a requirement, an obligation for these people to actually try to meet that because they want to keep their bonuses intact, the heavy level of compensation. So yeah, a lot of things going wrong here. This is one of those ones you read is so outrageous, but it happens all the time in practice. The unfortunate reality. All right, so I was going to let you out early. 8 minutes is good. Have a great weekend. We'll see you all on Monday for our final series.